Welcome back everyone. In this session we'll explore the different components of a bond's price: full price, accrued interest, and flat price. In the previous lecture we saw what yield to maturity is. We said it's the internal rate of return that makes the sum of the future cash flows, namely the coupons and the par value at maturity, equal the bond price. We also saw that our exercise of calculating that bond's yield to maturity was on a coupon date. That is, there was no accrued interest. In this lecture, we'll deal with how interest is calculated, because when a seller sells a bond between two coupon dates, the buyer agrees to pay the interest accrued between the last coupon payment date and the settlement date, which is usually the second business day following the trade date. We're going to differentiate between flat and full price, and at last we're going to illustrate the difference between the two primary conventions for day count in calculating accrued interest for a bond. We'll be referring implicitly to this modified equation, where these exponents that we use to compute the present values take into account the fraction of time in between two coupon dates. Before we get started, a quick reminder to download the essentials: the spreadsheet, the notes, and the slides. Now, let me share my screen so that we can start working together. You probably still remember our term sheet of Carb Fuel Aviation Services, CAS, with semi-annual coupons of 1.6%. Recall that the coupon is stated in annual terms, namely 3.2%, but the coupon payments occur semi-annually for 1.6%. The coupon dates are May 25th and November 25th. And the day count convention is specified as 30/360. Now, consider we work as junior portfolio managers for an asset management firm based in Stockholm, Sweden, and that on August 23rd, 2024, we have from a major international bank that serves as a corporate bond dealer many institutional clients in the Nordic countries, a quoted price for this bond of 104.79. We would like to sell part of our position at that price, and we want to determine the two components we would receive as payment for the sale of this bond. First of all, let's define what the full price is. It's the present value of the future coupons and par value at maturity, namely the bond price, as we've called it so far. It's also commonly called dirty price. What is the accrued interest? It's the interest that a seller forgoes when selling the bond between coupon dates. On coupon dates, the bondholder receives the full amount of the coupon. Accrued interest is the portion of the next coupon payment that the seller is entitled to receive. Although the seller has held the bond up until the sale date, the full coupon payment is only made on the coupon date. Finally, the flat price, also known as clean price, is the quote price. This is the global convention for quoting bonds. Bonds are quoted using full price minus accrued interest. Whilst the net amount we would get as sellers for this bond is the full price, the quoted price plus the accrued interest. To calculate accrued interest, we must determine the number of days in the period. In this case, the number of days between May 25th and November 25th. It depends on the day count convention. For this particular bond, the day count convention to be used is 30/360. That assumes that each month has 30 days, and that each year has 360 days. Being semi-annual, we're referring to a number of days of 180. The number of days that has passed since the last coupon, May 25th, for a settlement date on August 27th, that is the second business day after the transaction. Since August 23rd is a Friday, the second business day is Tuesday, August 27th, in Luxembourg, where the bond is traded. So the portion of interest, consider the coupon is 1.60, for this bond is given by this fraction here, 92 days divided by 180, times the coupon 1.6, equals 0.8178. Next to it, on the left, you can see the same calculation for the CAS bond had the day count convention been actual. Where is the difference? During the coupon period, there's a difference. The actual number of days between these two dates is 94 days, since the last coupon date, and 184 between the two coupon dates. Whilst using the 30-360 day count convention, there are 5 days in May. May 31st is not counted. 30 days in June, 30 days in July, July 31st is not counted, and 27 days in August, for a total of 92 days between the last coupon date and the settlement date, again using 30-360 day count convention. Between the two dates, May 25th and November 25th, there are 180 days based on 30-360. Thus, the full price we would get should we choose to sell at the dealer quote of 104.79 would be the flat price, 104.79, plus the accrued interest of 0.8178, for a total of 105.6078. And remember, the price we would determine by discounting the future coupons and the par value at maturity using an appropriate discount rate, in this case it would be 1.869%, would be the full price. We determine the flat price by subtracting accrued interest from the calculated full price. However, the quoted prices are always flat prices, with the exception of zero coupon bonds, whose quote is full, being that they pay no coupon during their lifetime. Now is the right time to discuss this matter. The full price of a fixed-rate bond between coupon payments, given a discount rate, is of course the present value of the future cash flows as of the settlement date, and is given by this formula. That is very similar to the equation we used in the previous lessons. This formula differs from that one because the next coupon payment is discounted for the remainder of the coupon period, which is given by 1 minus T over capital T. The second coupon payment is discounted for that fraction plus another full period, in this case one full period made of 6 months. 2 minus T over capital T, and so on. Considering all that, this equation can be simplified multiplying the numerator and the denominator by 1 plus r to the power of T over capital T. And that simplifies in the advantage of this formula is that the expression in square brackets implies a valuation when there are n evenly spaced periods. Then the sum of cash flows in present value terms is compounded for the fraction T over capital T, with the same required rate, which would be the yield to maturity. I have demonstrated this by backing into the dealer's quote using the two formulas we've just seen. On the right side, we've discounted the cash flows, namely the coupons and the par value at maturity, using full periods. Of course, we get a different and lower sum of cash flows than the one we get when discounting using fractional periods on the left. Then we compound for the fraction of time given by the portion of 92 days over 180, and we get the same result. Of course, we now have to use Excel's goal-seek function to determine the yield to maturity, always for demonstration purposes because we're not using Excel's function. We're doing this manually, and to seek the internal rate of return, we must use an iterative approach. This time, I'll ask Excel to seek a discount rate that returns a price equal to the dealer's full price. Previously, we did something similar by asking Excel to minimize to zero the difference in absolute terms between the calculated full price and the quote from the dealer. Now, if we move down here in this other section of my spreadsheet, we want to see what Excel's formula does when calculating both the yield to maturity and the bond price. On the left side, we've entered the input values we have from before, and we calculated the yield to maturity on the right side. Given the yield to maturity and the other input values, we calculated the bond price. Notice that Excel's formula outputs the flat price. So it calculates the full price and then subtracts from it the accrued interest. Now is the time to explain this argument in Excel's function that you find in both the yield and the price functions. Basis does just what we did at the beginning of this video, when we counted the number of days between the last coupon date and the settlement date and the number of days in the period, namely 180 days. By specifying the basis, we inform Excel's formula on which is the day count convention to be used. Specifically, by entering 0, Excel is informed on using 3360. We used for our cash bond, for example, whereas 1 is entered when we have to use the actual day count convention. There are other day count conventions that Excel can use, but these two are the most common, 3360 and the actual. Be sure to practice with the end of lesson questions to solidify what you've learned. And just a reminder, download the slides, the spreadsheet, and the notes if you haven't already. They'll greatly aid your study and review. In the next lesson, we're going to see the relationship of coupon, maturity, yield, and convexity with the bond's price. This will do for me now, and I'll see you in the next lesson.